Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$5.15. That's the number. Satellogic Inc., ticker SATL, closed today, Friday, January 23, 2026, right at 5.15. We tested a high of 5.22, but the close, that tells the story. And we're not just talking about price. We are talking about a liquidity event. Volume turnover was over what? 11.76 million shares. I mean, to put that in perspective, that's consistently hitting 500% of the 3-month average. If you pull up the chart, you're not looking at a slope, you're looking at a wall. It's a parabolic ascent from that $1.25 range we saw just a few months ago.
Vertical is one word for it. Untethered might be another. I mean, look at the context. This stock has completely decoupled from reality, or at least from the broader market. The S&P 500 is up a sleepy 1.4% year-to-date. It's basically flat. Meanwhile, Satellogic is up over 90%. So we're watching a violent repricing of risk, sure, but usually when risk gets repriced this fast, there's a hangover waiting on the other side.
Or it's a correction to the upside. The question isn't just why is it up, it's what changed. And we have the catalysts, right? The $18 million Portugal contract, the Craig Hallam buy rating with that $5 target, which, by the way, we just smashed through. But my argument is that this isn't just noise. This is the market finally waking up to a legitimate new space disruptor that is validating a whole new business model. We are not selling JPEGs of the earth anymore. This is sovereignty as a service.
Sovereignty as a service. It's a catchy slogan, I'll give you that. But I'm here to look at the math, not the marketing brochure. And what I see is a liquidity-driven bubble fueled by geopolitical panic and, let's be honest, a perception of political patronage, the Lutnik nexus, as I call it. I look at the numbers and I see a company trading at, 25 to 30 times forward sales? Compare that to the adult in the room, Planet Labs, trading at roughly 11 times. So is Satellogic a revolution, or is it just a short squeeze in a liquidity vacuum?
I appreciate the skepticism, I do, but comparing multiples right now is like comparing a startup to a utility. You're looking at the wrong metric. Let's actually dig into that sovereignty idea, because I don't think the market fully got it until this month. For years, the whole industry was obsessed with the subscription model. Planet Labs, Maxar, they sell you the data, you log in, you download an image. And that works. For agriculture, maybe for hedge funds counting cars. But we are in a fragmenting global order. Nations, especially Tier 2 military powers, they don't just want to rent data anymore. They want to hold the keys.
But why does ownership matter if the data's the same? An image is an image, right?
Is it though? Think about shutter control. If you rely on a U.S. commercial provider and the U.S. State Department decides a certain conflict zone is, sensitive, they can effectively blind you. They can restrict the resolution, they can delay the feed. If you're the Minister of Defense for Indonesia or Brazil or Portugal, that's an unacceptable strategic risk. The Portugal deal's the proof of concept. That's an $18 million deal with a NATO nation, not to rent a login, but to own the capacity of the satellite. They task it, they control it, they own the photons. That is strategic autonomy, and that commands a huge premium.
Okay, I follow the logic of the upsell. You're selling the fear of being cut off. But let's look at the valuation reality of that pitch. You're talking about a company with an estimated LTM revenue of around $25 million. That is tiny. And yet the market cap is pushing, $685 million? You mentioned Planet Labs. They have over $350 million in revenue. They have a massive historical archive. If I want to see what a field in Ukraine looked like 3 years ago, I go to Planet. Satellogic is banking entirely on these asset sales to justify a valuation that implies a hyper-growth we haven't seen in the filings yet.
But the filings are a lagging indicator. That revenue comparison is looking in the rearview mirror, and the market pays for the windshield. The differentiator here isn't the archive, it's the unit economics of their NewSat Mark V constellation. These aren't school bus-sized satellites. These things weigh 40 to 50 kilograms. They have sub-meter resolution, 50 centimeters. That is the magic number for defense.
Why is 50 centimeters the magic number?
Because at 3 meters, you see a building. At 1 meter, you see a car. At 50 centimeters, you can tell the difference between a civilian truck and a mobile missile launcher. That is the threshold for tactical utility. And SATL can manufacture these at a fraction of the cost of the legacy players, so it creates this low-cost moat that lets them sell the hardware directly to nations at a price point that Planet or Maxar they literally cannot touch without destroying their own margins.
Low cost is great, but revenue quality matters. Selling a satellite is a one-off hardware sale. It's lumpy. It is not the high-margin, reoccurring SaaS revenue that Wall Street usually loves. And I have to point out the mechanics of this rally, this price action. It screams mechanical squeeze. We have 8.22 million shares short, which is about 9.5% of the flow. Now, that might not sound huge, but you have to look at who owns a stock.
Right, the lockups.
Exactly. Between insider holdings and passive ETFs that just buy and hold, the actual lendable supply of shares has just evaporated. I was looking at the repo rates this morning, the cost to borrow, it's skyrocketing. If you want to short this stock, you are paying an insane fee just to keep that position open. It's like paying rent on an apartment that doubles in price every week. And that forces shorts to cover, which drives the price up, which forces more shorts to cover. It's a feedback loop completely unrelated to whether the satellites actually work.
I think you're mistaking a feature for a bug. The scarcity of shares is highlighting the scarcity of the asset itself. This stock has become a geopolitical hedge. In a world where prediction markets are flashing red on global conflict, SATL valuation naturally expands. It's one of the few pure-play assets that actually benefits from instability.
That is a dangerous game to play. If your thesis relies on World War III, you're buying an option on chaos. And if the world doesn't explode, that option expires worthless. But let's dig into the business model comparisons, because I think there's a misunderstanding of the competitive landscape.
Let's do it.
All right, so you have Planet Labs at a $4 billion cap, Black Sky at $800 million, and SATL chasing them at $685. Planet offers a 3-meter daily scan of the entire planet. They are the Google of Earth observation, searchable everywhere, all the time. Black Sky offers speed, low latency, AI-driven tasking. SATL is banking entirely on the sovereign sales model. My concern is they're competing against players with much, much deeper pockets and established government contracts. I mean, Black Sky is already entrenched with the NRO. SATL is the new kid trying to sell a different model.
I see why you'd think that. And here's a different perspective. Planet's archive is impressive, yes, but it's a legacy model. It's scanning. SATL is about remapping with high resolution on demand. The market is forward pricing the sovereign pipeline. You mentioned the $18 million Portugal deal. Let's look at how that money works. These deals are paid in milestones. That is critical. It funds their working capital up front. They don't need to go to the bond market to build the satellites. The customer pays for the bird before it even flies. 1 or 2 more deals that size, say with Indonesia or a Gulf state, and that revenue multiple compresses very, very fast.
That assumes they can close those deals. Sales cycles with governments are notoriously long. I mean, we're talking 18 to 24 months of just bureaucracy. And while they're selling this dream of sovereignty, they are still dependent on other public companies. They rely on SpaceX transporter missions for launch. If Elon raises prices, their margins get squeezed.
Everyone relies on SpaceX. That's a rising tide lifting all boats. But look at the Palantir partnership. This is crucial and so often overlooked. The integration with Palantir's Foundry means defense customers can task SATL satellites directly through the Aleph API.
Okay, explain that for the non-technical listener. Why does an API matter?
It's about sensor fusion. Imagine a defense analyst in a bunker in a NATO country. They're using Palantir to track troop movements. They see a blip on a screen from a radar hit. With this integration, they don't have to pick up a phone. The system can automatically trigger a SATL satellite to snap a high-res photo of that coordinate on its next pass. It crushes the kill chain timeline. It makes SATL sticky. Once you are integrated into the software that runs the war, you're very hard to rip out.
The Palantir connection is valid, and Palantir is a beast right now. But let's talk about what's actually moving this stock this week. It's not just the API, it's the conflict premium. The correlation with Polymarket is, it's undeniable, and frankly, it's a little unsettling.
It's data. The market is an efficient information machine. It doesn't have feelings. In mid-January, We saw polymarket contracts for U.S. military action in Iran in 2026 surge to nearly an 80% probability. That spike coincided perfectly, almost to the hour, with capital flows into SATL.
Right, but think about what that means. The stock is tracking the odds of people dying. It's become a reflexive asset. It is moving based on a narrative, war clouds over Tehran, rather than actual signed contracts. It's speculation on headlines.
I disagree. I think the stock is acting as a leading indicator. On January 8th, SATL announced a 7-figure monitoring agreement with an undisclosed customer. I mean, the market puts 2 and 2 together. Intelligence agencies don't buy pattern-of-life monitoring for fun. They buy it when they're preparing for operations. The stock rising as the ceasefire in Ukraine probability drops isn't just speculation. It's the market recognizing that in a protracted war, high-res imagery is a strategic necessity with zero price elasticity. If you need to see where the artillery is, you pay whatever it costs.
You realize what you're saying, right? You're telling me the bull case is Armageddon, that if I buy this stock, I'm betting against world peace. That is a bleak way to make $5. But beyond the morality of it, consider the risk of the peace dividend. If those polymarket odds flip, if a diplomat pulls off a miracle, the air comes out of this balloon instantly. The stock is inversely correlated to peace. That is an incredibly high beta risk.
It is, but we analyze the world as it is, not as we want it to be. And the current reality requires this hardware. But talking about government contracts and war brings us to the other big elephant in the room, the governance. We have to talk about Howard Lutnik.
The Lutnik nexus. This is the part that makes compliance officers sweat. So Howard Lutnik, former chairman of Cantor Fitzgerald, who sponsored the SPAC that took SATL public, is now the U.S. Commerce Secretary. Upon confirmation, he transferred control of his massive stake to trusts managed by his son, Brandon Lutnik. We're talking about roughly 13.4 million shares and warrants.
It was a required divestiture. He followed the legal protocol. He stepped away.
Oh, come on. It's divestiture in name only. The economic interest stays in the immediate family. You hand the keys from the father to the son. This invites congressional investigations. We already have Senators Warren and Dean calling for inquiries. And if an investigation opens, do you really think government contracting officers are going to be rushing to sign deals with SATL? It creates a toxic touch. No one wants to risk their career signing a contract with a company that's under a Senate probe.
I see the risk, but I would frame it differently. I call it the Lutnik put. You have to look at what the Commerce Department actually does. They control the Bureau of Industry and Security, BIS. BIS handles export licenses. They also house NOAA, which regulates remote sensing licenses.
Exactly. That is the conflict.
Or it's the tailwind. A friendly administration pushing an America First space policy wants domestic or at least non-Chinese operators to win. Now, SATL may have been founded in Argentina, but it's domiciled in the U.S. now. If the Commerce Department relaxes export controls for sales to friendly nations or speeds up NOAA licensing, that is a regulatory moat competitors can't easily cross. The market is betting the political connections are a net benefit, not a liability.
A bet on political patronage is the riskiest bet in Washington. Administrations change, scandals happen, but let's look at the plumbing again, the market microstructure. You mentioned the volume, but I want to highlight the dark pool activity. It's exceeding 32% of total volume.
Which usually signals institutional accumulation.
Let's break that down. A third of the trading is happening off exchange. For a small cap like this, it's usually what, 10, 15%? When it spikes like that, it means the whales are moving and they're trying to hide their footprint. But combined with that short interest we talked about, we are sitting on a powder keg. My worry is the air pocket.
The air pocket?
Because the float is so constrained by insiders, Lutnik's Trust, Mnuchin's Liberty 77 Capital, there are very few shares actually trading. If the sentiment turns, say, a peace treaty is signed, or that ethics probe is launched, there are no bids. The liquidity just vanishes. The stock could fall through the floor just as fast as it rose because there's no one there to catch it.
I'm not convinced. We've seen the chart test support and hold. Look at the stair-step pattern. It held 350 firmly in mid-January. It broke $5 and consolidated. That isn't a pump and dump. That's accumulation.
And the cost to borrow tells me the shorts are trapped. They are bleeding out. Eventually, they have to cover. And that structural bid puts a floor under the price.
The cost to borrow is rising because the risk is rising. And let's not forget the balance sheet. Yes, they raised $90 million in October 2025.
Which killed the bankruptcy thesis. That was the whole bear case. They run out of cash by Christmas. And they didn't. It delayed it. They are still burning cash. They are not profitable. If they have to raise capital again at these levels, or if the stock crashes and they can't, they're in trouble. The $90 million gives them runway, maybe 12 to 18 months, but it doesn't solve the fundamental problem unless they scale those sovereign sales dramatically.
And that brings us back to the core thesis. They are scaling. The Portugal deal proves the model works. The $30 million contract in April 2025 for AI-first services proves the tech is validated. We're seeing a shift from can they build it to how fast can they sell it?
But is it enough to justify 30 times sales? That is the question. You are paying a Tesla multiple for a hardware company in a regulated industry.
In a growth phase for a disruptive technology, multiples are often distorted. You're paying for the future state of the world, not the trailing 12 months. You're buying the Henry Ford of space.
Or the DeLorean. Let's wrap this up with our final takes because we are looking at two very different futures here.
I'll start. I believe SATL has decoupled from traditional tech for a reason. It is now a derivative of U.S. political economy and global instability. The company survived the bankruptcy thesis with that October raise. In a world fragmenting into rival blocks, every Tier 2 nation needs its own eyes in the sky. They can't rely on the U.S. or China. They want their own hardware. SATL is the only company mass-producing sovereignty at a price that makes it accessible. The Mark V technology is the driver, and the political tailwinds are just the accelerator. I see this going higher.
And I come at it from a different way. I see SATL as an option on chaos trading at bubble multiples. You're paying a massive premium for a Lutnik put that could easily turn into a political scandal. The risk of an ethics investigation is non-zero, and the risk of global de-escalation, which would be good for humanity but bad for the stock, is real. If that narrative shifts or if the short squeeze runs out of fuel, the fundamentals simply do not support this valuation. We could easily see a return to the 150 range. The Lutnik premium is just too high for my blood.
Well, we agree on one thing. The stock is absolutely decoupled. It's become a proxy for the world we live in.
Indeed. And whether that world favors the Mark V technology or punishes the political connections, that's for the listener to decide.
And that's where we'll leave it.
Until next time.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.